In 2017, a company that once ruled the dreams of millions filed for bankruptcy. Its stores went dark, its aisles fell silent. Toys R Us, once the undisputed king of toy retail, collapsed under a mountain of debt. The question wasn't just how it failed. The mystery was how a company that owned childhood itself lost control of its own future. The story begins in 1948 in Washington, D.C., when Charles Lazarus opened a small baby furniture store. After World War II, the United States was entering a baby boom. Families were growing. Suburbs were expanding. Demand for children's products was rising fast. Lazarus noticed something important. Customers weren't just buying cribs and strollers. They were asking for toys. By the early 1950s, he pivoted. He rebranded the business as Toys R Us, betting on a radical idea for the time: a massive warehouse-style store dedicated almost entirely to toys. This was different from traditional department stores, where toys were just a small section on one floor. Lazarus built an entire world for children under one roof. The economic context helped him. America's middle class was growing. Shopping centers were spreading across suburbs. Cars made large format stores practical. The conditions were perfect for a new kind of retail giant. Through the 1960s and 1970s, Toys R Us expanded aggressively. Its business model was simple but powerful: massive selection, lower prices, and national scale. By ordering toys in huge volumes, the company could pressure manufacturers for discounts. Those savings were passed to customers, drawing even more families into its stores. The brand became a cultural symbol. Geoffrey the Giraffe, the company's mascot, appeared in TV ads that reached millions of homes. Children recognized the jingle. Parents recognized the prices. By the 1980s, Toys R Us had become the largest toy retailer in the world. The company went public in 1978, raising capital to fuel even more expansion. It moved beyond the United States into Europe and Asia. It diversified into baby products with Babies R Us. At its peak, the company operated more than 1,500 stores globally and generated over $11 billion in annual revenue. For decades, it controlled critical shelf space in the toy industry. If a toy maker wanted national exposure, it needed Toys R Us. That gave the retailer enormous negotiating power. The company wasn't just selling toys, it was shaping which toys succeeded. The first cracks didn't come from competitors on the street. They came from the internet. In the late 1990s, e-commerce began changing how people shopped. Amazon launched in 1994 and expanded beyond books into consumer goods. Toys R Us recognized the threat, but instead of building its own digital platform from the ground up, it made a critical decision. In 2000, Toys R Us signed a partnership with Amazon. Amazon would run its online toy store. In theory, Toys R Us would supply the products, and Amazon would provide the technology and logistics. The relationship quickly turned tense. Amazon allowed other toy sellers onto its platform, competing directly with Toys R Us. Lawsuits followed. The partnership ended in 2004. By then, years had been lost. Amazon had gained experience, data, and infrastructure. Toys R Us had fallen behind in e-commerce, but the bigger turning point came in 2005. That year, a group of private equity firms, Bain Capital, KKR, and Vornado Realty Trust, bought Toys R Us for about $6.6 billion. The deal was a leveraged buyout. That meant most of the purchase was funded with borrowed money, not cash from the buyers. The debt didn't stay with the investors. It went onto the company's balance sheet. After the buyout, Toys R Us carried more than $5 billion in debt. Every year, hundreds of millions of dollars went toward interest payments instead of store upgrades, technology, or competitive pricing. At the same time, competition intensified. Walmart and Target expanded their toy sections, using toys as low-margin products to bring customers into their stores. Amazon improved its logistics, offering fast shipping and growing convenience. So Toys R Us stores began to look outdated. Many locations were large, aging, and expensive to maintain. The company struggled to invest in modern layouts, digital systems, and supply chain upgrades. Financial reports showed a dangerous pattern. Revenue remained high, but profits were thin. Cash flow was heavily constrained by debt obligations. When sales dipped, there was no financial cushion. By the mid-2010s, online shopping had become a dominant force. Toys R Us tried to catch up with new websites and marketing campaigns, but the gap was wide. The company was fighting competitors that didn't carry the same financial burden. In September 2017, Toys R Us filed for Chapter 11 bankruptcy protection in the United States. The company said it needed time to restructure its debt and improve operations. But the holiday season, the most important period for toy sales, failed to deliver enough cash. Suppliers grew nervous. Some demanded faster payments or reduced shipments that led to empty shelves. Empty shelves led to lower sales. The cycle fed on itself. In March 2018, the company announced it would liquidate its U.S. operations. More than 700 stores closed. Tens of thousands of employees lost their jobs. One of the most recognizable brands in retail history disappeared from American malls almost overnight. The collapse sent shockwaves through the toy industry. Smaller manufacturers lost a major distribution partner. Some went out of business. Others were forced to rely more heavily on Amazon, Walmart, and Target. Competitors gained market share. Amazon strengthened its position as a default destination for toys. Big box retailers absorbed much of the physical retail demand. The investors recovered parts of their investment through international operations and real estate assets. The core U.S. retail business was gone. In later years, the brand made attempts at revival. Smaller format stores opened. Partnerships were formed. The name still carried recognition, even if the original empire was gone. The financial lesson became a case study in business schools. A strong brand and high revenue could not overcome structural debt and delayed adaptation to technological change. Toys R Us didn't fall because people stopped loving toys. It fell because the rules of retail changed. And the company carried the past into a future that demanded flexibility, speed, and investment. Its rise was built on scale and selection. Its collapse was shaped by debt and delay. In the end, the story wasn't about losing childhood, it was about losing the ability to evolve.